So all around Bangalore, you can see these 99 variety dosa stalls. And you know where the fun is? It's in how he makes the entire thing. A dollop of batter on that hot iron plate, a sprinkle of oil, the smearing of the potato masala, the cheese, and of course the coconut chutney. Now my favorite is the paneer cheese Szechuan Mysore masala dosa with extra butter. And if you spend some time on the stall, you'll notice 70% of the customers ask for pretty much the same thing. Bhaiya ek masala dosa de do. Now why am I talking about all this? That's because something similar happens when we think of index funds, and the default thought is invariably the Nifty 50 index fund. But thankfully there is a lot more to index funds, and in this video I'll serve you not one, not two, not three, but 11 different types of index funds. I won't go into details of what an index is, how is it designed, etc. We'll keep that for a different video. But to put it in a sentence, think of an index as a system that identifies certain stocks, bonds, or other instruments from a larger universe and which is based on a defined methodology. This might seem a little cryptic now, but believe me, it will become a lot clearer as we move along in this video. So let's begin. The first type is a broad market index fund, and its objective is to track a sizable portion of the entire market. In equities, for example, there is the Russell 3000 index that represents 3000 of the largest publicly traded US companies and is approximately 98% of that country's total stock market capitalization. In India, we have the Nifty 500, which is 96% of the total market cap of companies listed on the NSE, and there's also a fund by Motilal Oswal that tracks this index. Now I'm listing some specifics about the Nifty 500 on the screen here, but one of the arguments I often hear is that this index is over diversified. Well, truth be told, I think a lot of people really don't understand this word over diversification. If you think this means a high count of stocks, then you better think again, because in fact over diversification happens when you allocate your money, your capital, to lower conviction ideas instead of doubling down on the high conviction ones. So it's not about the number of stocks, it's more to do with conviction, which is purely an active investing concept and has no place when it comes to passive or index investing. Next comes market capitalization based index funds, which, as the name suggests, is based on specific ranges of market cap. When it comes to India, the Nifty 50 index generally consists of companies with a market cap of over 1 lakh crores. The Nifty Midcap 150 has companies between 16,000 to 45,000 crores and so on. In fact, there are many subsets within every market cap range as well. For example, within large cap companies, we have the Nifty 50, the Nifty Next 50, and the Nifty 100. Within mid-caps, there is a mid-cap 150, but then there is also a mid-cap 50 index. And similarly, there is the popular small-cap 250 with a few small-cap 50 funds added to the mix. Now, interestingly, these market cap indices are not exactly based on the market capitalization of the constituent companies. Instead, the companies within these indices are picked on the basis of their free float market capitalization. So free float refers to those shares that are readily available for trading in the stock market, which means it excludes any holdings by the company's promoters, the government, a strategic investor, shares which have been locked in, etc., that won't be floated on the market for normal trading. For example, the Life Insurance Corporation of India is the 11th largest company on the basis of its total market cap. However, and as we are all aware of, more than 96% of the outstanding shares of this company are with the government of India, which means on a free float basis, LIC is definitely not the 11th largest. In fact, LIC ranks at 146th on a free float market cap basis, which keeps this company well outside the Nifty 50 list of companies in spite of it being a giant. Now, the issue with market cap based indices is that a few companies always carry a much larger weight and can therefore skew the index. For example, and within the Nifty 50, the top 5 companies, that is Reliance, HDFC Bank, ICICI Bank, Infosys and HDFC, these 5 companies together have a weightage of about 50%, which seems odd and distorted. Now, one school of thought says to the winners should go the spoils, which is fine, but accidentally what's also happening is that as index funds continue to grow in India, it's only making the strong stronger. which in investing language means that the bigger companies might be becoming overvalued at the expense of the smaller companies like the ones that are ranked between 40 and 50 within the Nifty 50 index. That's where an equal weight index fund comes in, as it solves this issue by allocating the same weight to every constituent company. For instance, the Nifty 50 has 50 companies, so 100 divided by 50, which means every company gets a weight of exactly 2%. By doing so, one of the more visible differences is a lot more sectoral diversity that an equal weight index is able to offer as compared to its market cap weighted cousin. And because the methodologies are different, the returns of these two indices does vary from time to time. A hybrid index is obviously a combination of assets or sub-assets. For example, on niftyindices.com, one can see a series of Nifty 50 hybrid composite debt indices. Let's pick one. Let's go with the most aggressive one, which is the Nifty 50 hybrid composite debt 70/30 index. Now, if your own portfolio is an aggressive one, that is, you have a majority of your corpus in equity, then benchmarking your portfolio performance against this particular index will give you the ideal comparison. Similarly, most aggressive hybrid funds use the 70/30 index as the benchmark, and in the same thread, most conservative hybrid funds would pick a more sedate index. On the equity side, there are indices and funds that work on a combination basis. For example, one of the indices is the Nifty Mid Small Cap 400, which is something I use to benchmark my stock portfolio because a lot of it, in fact, all of it is in mid and small cap companies. Similarly, there is also the Nifty 500 Multi-Cap 50-25-25 index, which is again something I use for benchmarking because my overall equity portfolio is very close to this composition. And finally, there is the Nifty Large Mid-Cap 250 index, which is a portfolio of 100 large cap and 150 mid-cap companies, with each capitalization set having a 50% weightage. One of the AMC's Edelweiss operates an index fund that mimics the large mid-cap 250 index and is generally positioned as a passively managed competing product to flexi-cap funds. I've added the fund's presentation in the video's description along with some additional reading material on many of the things that we have learned so far in this video, so do check that out. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. Next up are sector-based index funds, and as one might have expected, these funds track a specific sector of the market such as banking, IT, transportation, healthcare, energy, etc. Now, the incentive and danger behind investing in a sector fund are the peaks and troughs that each industry or sector goes through. I think the best example of that is the Nifty IT index, which has seen massive ups and downs over the last 3 to 5 years. And it's not just the IT index, but almost every sector goes through this volatile journey, which means timing one's entry and exit is perhaps the most crucial skill when investing in these funds. It's this volatility that allows investors to achieve superlative returns, but if the prediction goes wrong, then it can also lead to some serious losses. All said and done, I don't think sector-based index funds are suitable for all kinds of investors, and even if one dabbles with it, in my view, the aggregate exposure should not be more than 10%. Thematic index funds focus on specific themes or trends such as clean energy, consumption, infrastructure, defense, digital, healthcare, manufacturing, etc. As compared to sector funds, thematic funds try to identify future trends and often present a bouquet of stocks which can be from the same or even different industries and sectors. For example, a healthcare fund need not be just hospitals or medical device manufacturers. It can also include insurance companies, especially health insurance companies. It can also include TPAs, medical loan providers, and also technology companies that are developing hospital CRM softwares, etc. So it's an entire ecosystem, a trend, and it's the enablers and beneficiaries of that trend that become part of a thematic index fund. Now, the Indian mutual fund industry has been getting really busy in the thematic space with a number of launches in the last couple of years. Most of them are actively managed funds, but if the response is good, then I won't be surprised if they launch a few passively run schemes as well to go with the ICICI Pru Nifty Auto Index Fund and the Navi Nifty India Manufacturing Index Fund. Factor-based index funds are also called smart beta index funds, and they invest in stocks that meet a certain criteria. Now, we've already discussed a major criteria earlier in the video, that is market capitalization. But factor funds are built around some other variables and attributes like the P ratio, the dividend yield, book value, cash flow, sales, etc. that can probably do a better job of identifying attractively valued companies for an index portfolio. It's a scientific combination of these attributes that is then packaged as a factor, and the most important factors include things like value, which is usually captured via the PB ratio, the P ratio and the dividend yield, momentum, which is entirely price and volume based, quality, which has a range of attributes within it, low volatility, etc. Now, once these factors and the methodologies is identified, a lot of computing power is used to convert the financial metrics and complex data streams into a smart beta portfolio. Some of these smart beta funds are based on a single factor, while others use 2, even 3 factors. The last couple of years has seen a number of fund launches in this category, which coincides with its growing popularity all around the world. Factor indexing is something I am keen on learning and exploring, and I'll certainly have a separate video on it very soon. Like the one Bobby Axelrod ran in the TV series Billions, hedge funds employ a number of strategies to generate excess returns for their investors. They often use short selling, derivatives and leverage, which are strategies that don't come easily to everyday investors like you and me. But that doesn't mean that these options aren't available. For example, there is something called the Nifty 50 TR2X leverage index. The strategy this index employs is to magnify the exposure to the Nifty 50 index by a multiple of 2 and hence the 2x, which means if the Nifty 50 goes up by 5%, then the value of this index will go up by 2 times of 5%, that is 10%. Now, finding such leverage funds is difficult. In fact, I couldn't locate a single fund or ETF in India that uses the 2x leverage approach, but I did come across one in Korea that made use of this very strategy. So leverage is just one strategy, and there can be a lot more techniques that can be applied when constructing an index fund. Strategies like arbitrage, futures, dividends, inverse index, beta, and even currency. All these can be used to create indices, and while these are not mainstream, I won't be surprised if some of these start finding a place in the index shelf maybe 3, 4, 5 years from now. International index funds invest in stocks and ETFs outside of India, wherein they track indices like the Nasdaq 100, S&P 500, the MSCI World Index, etc. In fact, it was the Nasdaq's meteoric rise for the last few years up until the year 2021 that built a lot of interest amongst investors, which consequently led to fund houses introducing a number of schemes in this category. But 2022 wasn't kind to these funds, as firstly the performance dipped due to many internal and external factors, and then the SEBI had to stop mutual funds from taking in fresh subscriptions due to an RBI mandated limit of $7 billion for overseas investments. But broadly speaking, international funds do have a role to play in an investor's asset allocation structure, not only in terms of returns, but remarkably, a lot of these funds have a weak correlation with domestic funds, which is good from an asset allocation standpoint. Case in point is the NYSE FANG Plus Index, which is all technology stocks, and it has a correlation of just 0.15 when compared to the Nifty 50. So keep this in mind, and as and when these restrictions are lifted, do ensure you study each international index fund in isolation, as every scheme has different characteristics, and do make it a part of your asset allocated wealth portfolio. Index funds often give the impression that these are stock market linked equities, as we generally call it. But surprisingly, there are a good number of debt-based index funds that investors can put their money into, and a lot like equity index funds, these are passively run and track a benchmark, they follow a particular methodology, and they charge very low in terms of expense ratios. Now, a bulk of these index funds are categorized as target maturity funds, although I think there is also a short duration and also an overnight index fund there. So target maturity funds are rather popular bond indices as they solve two nagging problems. Firstly, it allows investors to ignore the up and down price movement in bonds that happens due to interest rate changes. And secondly, most of these bonds have almost no credit risk in them, as these are generally a Government of India bond or state development loans, or at worst, these are AAA rated PSU bonds. It also helps that these target maturity index funds come with different maturities, varying asset mixes, and with many fund houses launching a number of these indices in the last 2-3 years, there's a lot more choice for the consumer as well. Socially responsible index funds have become increasingly popular in recent years, with investors caring about how their money is invested in addition to the investment returns. You might have come across the abbreviation ESG in that context, which stands for environmental, social, and governance. And the aim here is to invest in companies which are in line with this thinking while excluding companies that are involved in the sale of firearms, alcohol, tobacco products, gambling, polluting industries, etc. The ESG trend is not quite there in India, but it has definitely picked up pace in the more developed markets. And according to a Bloomberg study, sustainable investing has an estimated $37.8 trillion in assets under management in FY 2022. So watch out for this trend, and this concludes our 11 different types of index funds. The point is, index funds have surely come a long way since 1976, when the Vanguard Group launched the first publicly traded index fund. And today, with so many options, permutations, and combinations available, I think index funds can sufficiently address a large part of our core portfolio, including our need for large, mid, and small cap funds, factor funds, international funds, bond funds, and even tax saving funds, with the SEBI allowing AMCs to launch an ELSS index fund. So there's a lot when it comes to index funds, and I'll try to get into more details in future videos. Once again, thank you for your time. Do like this video, encourage your friends to subscribe to my channel, and I'll see you soon. Until then.